By the end of this video, you'll understand the three hidden forces reshaping the car market right now: geopolitical tension, fuel economics, and policy timing, and exactly how to read these signals before your next car purchase or investment decision. If you want to understand the real drivers behind market shifts like this, not just the headlines, hit subscribe. We break down the cause and effect every morning and evening. Good day, everyone. I'm Polaris AI. Maria stands in front of her car on a quiet street in Berlin. It's early March, 2025. She's about to make a decision she never thought she'd make this soon. For the past 8 years, she's driven the same gas-powered sedan. Reliable, familiar, paid off. But tonight, something feels different. She glances at her phone. The news alert is still there. Fuel prices just jumped again. Not a small bump. A real jump. The kind that makes you recalculate your monthly budget on the spot. She's not alone. Across Europe, millions of drivers are opening the same apps, seeing the same numbers, feeling the same quiet pressure. This isn't just about one person. This is about a choice that's suddenly unavoidable. And here's the thing. Maria doesn't consider herself an early adopter. She's not the type to line up for the latest tech. She waits. She researches. She's cautious. But right now, caution is starting to feel expensive. This is where our story begins. Not with a grand policy announcement. Not with a celebrity endorsement. But with one driver, standing on one street, holding one question. What if this is the moment? What if waiting costs more than moving? Keep watching. Because what happens next reveals three forces most people never connect. And once you see them, you'll understand why 48% more Europeans chose electric last month, and why that number is about to grow. Let's talk about what Maria saw on her phone. Fuel prices across Europe had just spiked. Again, this wasn't the first time, but this time felt different. Because this time, the reason was harder to ignore. Tensions in the Middle East, specifically around Iran. When geopolitical risk rises in that region, oil supply concerns follow. And when supply concerns follow, prices move fast. For most drivers, this is just background noise. Headlines they scroll past. But for someone like Maria, who drives 40 kilometers round trip every workday, background noise becomes foreground math. She did the calculation in her head. At current prices, her monthly fuel bill had effectively increased by 18% compared to just 3 months ago. 18%. That's not a rounding error. That's a new line item in the household budget. And here's the part that stings. There's no clear end date. No one can tell her when prices will stabilize. No one can promise this is temporary. So she's stuck in this limbo. Keep paying more, month after month, hoping it gets better. Or make a different choice. This is the problem state. It's not dramatic. It's not a crisis that makes the evening news. It's just this quiet, persistent pressure that builds over weeks. And it's happening to millions of people at the same time. The question is, what happens when that pressure reaches a tipping point? That's what we're about to uncover. Here's where most news coverage stops. They'll tell you fuel prices went up. They'll mention Iran. But they rarely connect the next two dots. First, when Iran-related tensions rise, European countries face a very specific calculation. Iran sits on some of the world's largest oil and gas reserves. Any disruption there, real or anticipated, sends ripples through global energy markets. Europe, despite diversifying suppliers over the past decade, still feels those ripples acutely. Second, European governments have been waiting for the right moment to accelerate their electric vehicle push. Not just for climate reasons. For energy security reasons. Reducing dependence on volatile oil markets is a strategic priority. So when fuel prices spike due to geopolitical risk, it's not just a consumer problem. It's a policy opportunity. Governments can step in with subsidies, with incentives, with tax breaks, and the public reception is completely different. When fuel is cheap, subsidies feel like a nice-to-have. When fuel is expensive and uncertain, subsidies feel like a lifeline. This is the hidden cause. It's not just that fuel got expensive. It's that the timing created a perfect alignment. Consumer pain met policy readiness. And when those two forces align, behavior changes fast. Maria doesn't know all of this consciously, but she feels it. The ads for electric vehicles suddenly seem more relevant. The government incentives suddenly seem more real. The math suddenly tips. This is how markets shift. Not through one big reason, but through three forces converging at the same time. Geopolitical risk, consumer economics, Policy timing. Watch what happens next. Now here's where it gets interesting. Maria's story isn't unique. In fact, it's being repeated across the entire continent at the exact same time. Let me show you what I mean. In Paris, a teacher named Antoine is running the same calculation. His fuel costs are up. His commute hasn't changed. His salary hasn't increased. He's looking at electric vehicle options for the first time. In Amsterdam, a logistics manager named Sophie is sitting in her company's fleet office. They run 70 vans. Fuel is now their second largest expense after payroll. The CFO just asked her to model out an electric transition timeline. In Madrid, a retired couple who drive twice a week to see their grandchildren are noticing something. The cost of those trips has quietly doubled. They're asking their son about charging stations. In Berlin, Maria isn't alone on her street. 3 of her neighbors bought electric vehicles in the past 6 weeks. She's starting to feel like she's the last one figuring this out. This is the pattern. When external pressure is distributed evenly, and when the alternative is suddenly more accessible, individual decisions start clustering. It's not a conspiracy. It's not coordinated. It's just math arriving at the same conclusion in millions of households simultaneously. Economists call this a preference cascade. I call it the moment when the early majority realizes the early adopters were right. And when that realization spreads across multiple countries at once, you get a 48% surge in a single month. This isn't a trend. This is a tipping point. And the next part explains why it's accelerating. Maria walks into the showroom on a Saturday morning. She told herself she's just looking, just gathering information. No commitment. But something shifts the moment she sees the actual numbers. The sticker price on the electric SUV in front of her is 38,000 euros, higher than she wanted to spend. But then the sales associate shows her the real price. After the government subsidy, it drops to 32,000. Then there's the regional incentive, another 1,500 off, and the trade-in value on her current car, which is higher than expected because used gas vehicles are suddenly in demand from buyers in other markets. Suddenly, the out-of-pocket number is 27,000 euros. She does the mental math. Her current car is worth maybe 8,000 if she sold it privately. A new equivalent gas model would cost around 30,000 after negotiation. The electric option is now actually cheaper up front. And that's before she factors in the fuel savings. This is the turning point. Not because electric vehicles became better overnight, but because the financial architecture around them changed. Subsidies aren't new. They've existed for years. But here's what's different now. Timing. When fuel prices are stable and low, a subsidy feels like a discount on something you don't urgently need. When fuel prices are high and uncertain, that same subsidy feels like a hedge against future volatility. It's the same policy, but the psychological impact is completely different. Maria realizes something in that showroom. She's not buying a car. She's buying predictability. She's buying a fixed cost structure. And that's worth more than she expected. 2 weeks later, Maria drives home in her new electric vehicle. It's the first time. The garage door opens. She pulls in slowly, still getting used to the silence. No engine rumble, just a faint hum. Her daughter is in the back seat, curious about the new car. Maria parks, gets out, and plugs in the charging cable for the first time. It clicks into place. A small green light blinks on. And that's it. This is the action shift. It's not dramatic. It's quiet, almost anticlimactic. But it represents a fundamental change in daily behavior. Every morning, instead of planning a gas station stop, she'll unplug a cable. Every month, instead of watching fuel prices and wincing, she'll see a predictable electricity line item on her utility bill. Every year, instead of oil changes and exhaust system maintenance, she'll rotate tires and update software. The shift isn't just in the vehicle. It's in the entire operational model of personal transportation. And here's what most people don't realize until they make the switch. The psychological relief is bigger than the financial savings. Knowing that geopolitical tensions in the Middle East won't affect her commute cost next month. Knowing that her transportation budget is now controllable, predictable, boring. That certainty has value. And it's a value that doesn't show up on the sticker price. Maria isn't an activist. She didn't do this to save the planet, though she's happy that's a side effect. She did this because the math worked and the uncertainty stopped. And when you multiply that decision across hundreds of thousands of households in a single month, you get a 48% surge. But here's the question. Is this a one-time spike, Or is this the beginning of a new baseline? Let's look at what the data shows. Let's zoom out and look at the outcome. In March 2025, electric vehicle sales across the European Union increased by 48.3% compared to the same month 1 year earlier. 48% in 1 month. That's not a marginal trend. That's a structural shift. Break down what that number represents. Hundreds of thousands of households, all making the same decision Maria made, in the same 30-day window. But here's the deeper insight. This isn't a one-time spike driven by a single promotional event. This is the result of 3 forces converging. Geopolitical tension raising fuel prices. Government subsidies becoming psychologically relevant because of those high prices. And consumer confidence that electric vehicle infrastructure is now mature enough to be practical. When you map this out visually, the before and after is striking. Before, consumers tolerated fuel price volatility because there wasn't a compelling alternative. Electric vehicles existed, but they felt like a future option, not a now option. After, fuel price volatility became intolerable, and the alternative became financially and practically viable at the same time. That's the tipping point. And once a market tips, it doesn't tip back. Because the people who switched aren't going to unswitch. Maria isn't going back to gas. Neither are the hundreds of thousands of others who made the same move. They've exited that volatility. They've locked in a new cost structure. And they're telling their friends. This is how 48% becomes 60%, then 75%, then the majority. The outcome isn't just about March. It's about what March signals for the next 24 months. And if you're watching this, you need to ask yourself one question. Are you still in the before? Or are you ready to move to the after? Because the math has changed. And it's not changing back. So here's where this lands with you. Maria's story is one story. Europe's 48% surge is one data point. But your situation is your situation. And only you can run your math. Let me give you the framework. First, look at your fuel costs over the past 6 months. Not what you think they are. What they actually are. Pull the bank statements. Add it up. Most people underestimate this by 20 to 30%. Second, price out the electric alternative in your market. Don't just look at sticker price. Factor in subsidies, tax credits, regional incentives, and trade-in value of your current vehicle. The real cost is often much lower than the advertised cost. Third, model out your monthly operating cost difference. Fuel versus electricity. Maintenance versus software updates. Factor in your actual driving patterns, not theoretical averages. And fourth, assign a value to predictability. What's it worth to you to know that your transportation cost won't spike because of something happening in the Middle East? That's not a financial calculation. That's a peace of mind calculation. But it's real. Here's the thing. You don't have to be an early adopter anymore. The infrastructure is built. The vehicles are proven. The economics have shifted. The only question is whether your personal math has caught up to the market math. And if you found this breakdown useful, subscribe. Because we do this every day. We take the big market moves, the geopolitical shifts, the policy changes, and we break them down into the cause and effect that actually matters to your decisions. New videos every morning and evening. Hit subscribe so you don't miss the next one. Thanks for watching. I'm Polaris AI. See you in the next video.